Good afternoon, and thank you for attending today's Super 101 webinar. We'll give everyone a few moments to join the webinar, and we'll commence shortly. Once again, guys, thank you so much for attending today's Super 101 webinar. My name's Jack. I'm a member account specialist with Brighter Super. An important part of my role is guiding our valued members toward a comfortable retirement. By the end of today's webinar, we aim to give you some useful information on the basics of superannuation. I'm joined today by one of our member account managers, Silas Dangiria, who will be monitoring your questions in the chat today. Brighter Super acknowledges the traditional owners of the lands we meet on today and pay our respects to the elders past and present. We are proud to serve Queensland's 17 Indigenous councils and strive to provide positive outcomes for our members who identify as Aboriginal or Torres Strait Islander. It's important to understand that the information and the examples contained in the webinar are general in nature and have been prepared without taking into account your individual objectives, financial situation, or needs. It is important when making decisions about your super options that you obtain the relevant product disclosure statement in the target market determination and consider your own personal circumstances. You can access these documents and the privacy policy and financial services guide from the Brighter Super website. Today's presentation will run for about 30 minutes. Many of you have submitted questions already, which we have tried to incorporate into the presentation. You can also post questions in the Q&A feature during our presentation today, which we'll aim to answer directly. As mentioned, we have Silas standing by as the moderator today. Silas is our moderator and they have been with the fund for 2 years. He's regularly out in the field providing super health checks to members in different regions all across Queensland. Would you like to introduce yourself, Silas?
Thanks for that warm introduction, Jack. Yes, as Jack said, I've been with the fund for the last 200 years. All in all, I've been in financial services for just over 30 years. So we are here to assist you in making the most of your super. So thank you very much for attending. Back to you, Jack.
Thank you so much, Silas. We should have some time for questions at the end, and we'll try to answer as many as possible. We'll also be running some poll questions throughout today's presentation. So when the question pops up on your screen, please click an answer that is appropriate to you. Before we move on to our main subject, I would like to take the opportunity to briefly explain who we are, as we have some non-members joining us today. The merger between LGIA Super and Energy Super, plus the acquisition of Suncorp Super, has enabled us to increase our size and scale, yet we remain committed to investing in personalised member services that you know and enjoy. We serve over 280,000 members with more than 34 billion in funds under management. We have received double-digit returns for the balanced accumulation and balanced pension options in the full year 2024. Now let's talk superannuation. The purpose of superannuation is to preserve savings to deliver income for a dignified retirement. Now, most of us make our contributions during the year, but we don't think about how much we need as we get closer to retirement. So let's review what superannuation is and how it works. Super is linked to your employment. Your employer contributes money into an account on your behalf. Your money is then invested. Any fees and insurance premiums are then deducted, and what remains is your benefit. Superannuation is a long-term investment, so making good decisions early is essential, and the earlier you start, the better. There are benefits of contributing extra to your super. The money your employer is putting into super for you is a great start, but by adding a bit more, you can make a huge difference to make your retirement balance. And now is just the time to start to think about your super, even if it feels like a long way off. Compounding returns makes a difference. You don't need to add a lot to have an impact. Salary sacrificing is a common example of additional contributions, and we'll discuss that later in the presentation. There are some important points to consider before deciding whether to add extra funds into your super. One, with all contribution types, there are contribution caps to be mindful of. Two, depending on your level of income, some types of contributions may be more or less tax effective, so you should carefully consider which is right for you. And three, you should review your budget to ensure you can support the reduction in take-home pay. And lastly, any additional contributions you make also form a part of your preserved amount, which you cannot access until you meet a condition of release, which is generally retirement. So now that we know what superannuation is, we need to talk about the contribution options. There are two main types of super contributions: concessional, or before tax, and non-concessional, also known as after tax. Both have limits or caps. The concessional contribution cap for the current financial year is $30,000. Concessional contributions are made from pre-tax money and include employer contributions, salary sacrifice, whether that be mandated or voluntary, or tax-deductible personal contributions. If you exceed the concessional contribution cap, there may be additional tax to pay. Non-concessional contributions come from funds that you have already paid tax on. This is why these contributions are also known as after tax. Under current rules, you can potentially contribute up to $120,000 per financial year as non-concessional contributions. If you are under the age of 75, you may potentially bring forward up to 3 years worth of contributions, so up to $360,000, depending on your total super balance. If you're considering making extra contributions to your super, please consider seeking advice. Later in the presentation, we will discuss how we can help you with this. On the previous slide, we discussed the concessional cap of $30,000. To grow your super, some members may be able to use what is called the carry forward rule, which may allow you to access any unused concessional caps from the previous years. So for example, if last year you contributed $20,000 of your concessional contribution cap, this year you may be able to add or a further $10,000. Therefore, in this example, a member may be able to contribute $40,000. You must have a total super balance that is under $500,000 at the end of the previous financial year. Members may have up to 5 years to use any unused concessional amounts. Remember, concessional contributions may include salary sacrifice or tax-deductible contributions. It's important to seek tax advice to ensure it is beneficial to your circumstances. You can find out your personal unused concessional contributions through MyGov through the ATO portal under the tab Superannuation. Let's now discuss salary sacrifice. Australia has a tiered personal taxation system, which means we get taxed at a progressively higher rate the more we earn. For this example, we will look at someone that is earning between $45,001 and $135,000. Their overall marginal tax will be 30%, plus the Medicare levy of 2% if applicable. If you're earning over $135,000, the tax rate may be even higher. Let's apply this to super contributions. An after-tax contribution simply means that income tax has already been deducted from the money before it is contributed into super. There is no tax on entry to the fund because it has already been taxed before you contributed into super. However, if your employer allows you to salary sacrifice, or if you can claim a tax deduction on an after-tax contribution, these contributions are taxed at 15%, which is a concessional tax rate and is why these are known as concessional contributions. This generally means for those earning between $45,001 and $135,000, you may pay less tax on the before-tax super contributions than you would on the after-tax contributions. A reminder that contribution caps still apply, which is $30,000 this financial year. Now, before we move on to an example, let's ask our first poll question. Do you salary sacrifice? Yes or no? Great. So it's good to see that we've got all of you salary sacrificing. It's great to see. Now let's look at an example. Now let's assume this member is contributing $5,000 to their super and they earn between $45,001 and $135,000. If they make an after-tax contribution, the tax paid would be $1,500. If their employer allows them to salary sacrifice, or if they claim a tax deduction, they'd be saving around $750 per year based on the difference in tax rates. It can potentially be a great way to boost your retirement savings. Meet Tina. Tina has recently turned 45 and is in a position to make extra contributions to her super. The following calculations have been made using our own retirement income calculator and our salary sacrifice calculator. She looks at making some salary sacrifice contributions. In option A, if Tina chooses not to contribute, she may retire with a balance of $416,000. However, in option B, if Tina contributes $100 a week over 15 years, she could potentially grow her super to just over $500,000. Because she is making this as a salary sacrifice contribution, the tax benefit means that she could take home, before she is making this, because she's making this as a salary sacrifice contribution, the tax benefit means that her take-home pay only reduces by $68 a week. Think about that. That's an extra $85,000 in retirement. As you can see, small changes over a point in time can make a big difference. Please note, this does not consider market volatility. At Brighter Super, we're here to help you. Our website contains a range of resources, including our salary sacrifice calculator, which we used on the previous slide in Tina's case study. It allows you to find out how you can maximize your super by contributing before or after tax. You can find this and the other calculators under our resources tab, and it takes about 10 minutes to complete. It also gives you the option to see if you can afford to contribute more by reducing your take-home pay. There may be another way to contribute, and this is called spouse contributions. So, what is a spousal contribution? If you contribute to your partner's super account and they have a total annual income of less than $37,000, you'll receive an 18% tax offset on the first $3,000 of contributions up to a maximum of $540. The offset gradually reduces for income above this level and completely phases out when your spouse's total annual income reaches $40,000. This is a tax offset, not a tax deduction. The contribution will be treated as a non-concessional contribution for your spouse. The contribution must come from your after-tax income. This is paid directly into your spouse's super. This may be beneficial if you or your spouse is having a career break or one earns less or is not working. The government co-contribution may be another type of contribution to consider. This is a payment to help boost your retirement savings. If you are a low or middle income earner and make voluntary after-tax super contributions, you could receive a co-contribution from the Australian government of up to $500. You have a total annual, if you have a total annual income of less than $45,400 this financial year, the Australian government will contribute 50 cents for every dollar you put into your super, up to a maximum of $500 in a financial year. The super code contribution amount gradually lessens as the income increases until it cuts out for those who earn $60,400 or more. To receive the maximum co-contribution of $500, you need to earn $45,400 or less and contribute at least $1,000 to your super. This can be beneficial for those entering the workforce on a part-time basis to grow their super and receive a benefit from the government at the same time. Like anything, rules and eligibility criteria apply, so for more information, please visit our website or reach out to us. On our website, under Forms and Info Sheets, you'll find information on all the contributions we have covered, plus other contribution types that may be available. Once you have the money in the super, you then want it to grow, so it will sustain you throughout your retirement. The reason why investing produces a return is because there's risk involved. If you give someone $1 and expect them to pay you $1.20 back next year, there is a risk you won't get your money back. This is a key to investing, understanding that risk. Brighter Super's aim is to grow our members' super balances while providing consistent returns. That means we want your investment to grow when markets are performing strongly and reduce the impact when markets start to fall. We place great value on diversification, which means not having all of your eggs in the one basket. To achieve this, we offer ready-made investment options which spreads your money across a number of different asset classes to reduce the level of risk. Each of our ready-made investment options offer the benefits of our strategically chosen investments. Depending on what stage of your working life you're at, what your retirement goals are, and how long you've got before you retire, you may want to take more or less risk. And we have options for you. We're going to talk about this over the next few slides. So some people think of their super as a single asset, but it can potentially be invested in many different assets. Most super funds offer different types of investment choices to their members. Investment choice is selecting which asset classes you're invested in, such as Australian shares, international shares, fixed interest, cash, or property. Investment options offered by super funds can either be diversified, which investing in a mix of different assets or classes, or single sector options, such as investing in just one asset class. Diversification can be achieved by choosing a ready-made diversified option, such as a growth or a balanced option, or by choosing a mix of single sector options. Choosing your own mix of different asset classes rather than a ready-made mix. So another poll question, do you know which investment option you're in? Yes or no? Okay, great. So we've got a pretty good range there of yes or no's. So thank you for answering those, guys. It's good to see some of you do, and it's completely fine that some of you don't. And this might be a bit of a good indicator to have a look in your own time. So assets such as equities, otherwise known as shares, are described as growth assets. These may see volatility over the short term. The value may go up and down, but Over a longer time period, they generally experience higher growth. Asset classes like cash and fixed interest are sometimes described as defensive options. They carry less risk in terms of volatility of returns and potential for capital loss, but they also offer less potential for higher returns. So these options are generally described as low risk or low return. Brighter Super offers 12 investment options, a combination of ready-made, diversified options and single sector asset classes. If you don't select an investment option, you will be invested in the default option, which is called My Super. Let's take a minute to look at the fund's default option, My Super. So according to Super Ratings, over the past 10 years, this option has delivered an average of 7% per annum return. This means over the past decade, you have doubled your money, and over this period, the My Super option, has outperformed the Medina of its competitor funds. In fact, 3 Brighter Super accumulation options and 2 pension options achieved the Super Ratings top 10 rankings for the 2024 calendar year. It's important to understand which investment option is best for you, and the best place to start is to look at your risk profile. Often, when I'm talking to people about investment choice, I'm asked the question, what is the best way to invest my super? And as you could imagine, there is not one single investment option or profile that would be a fit for everyone. In fact, there are a number of different things to consider when choosing the right risk profile for you. So, what is a risk profile, you may ask? A risk profile is an individual measure of how you feel about risk and return, keeping in mind that there is always a trade-off between these two. It takes into account your tolerance to market falls, as well as your investment timeframe and desired returned outcomes. For example, an aggressive investment is expected to generate a higher rate of return over the long run. However, it is likely to fluctuate more in value. What this means is that your investment may grow faster over time. However, it will generally lose more when the markets dip and produce more frequent negative return years. A more conservative investment, on the other hand, is likely to have fewer negative return years overall and may not drop as far as an aggressive investment option during a downturn. However, the trade-off for less downside risk is that the positive returns are expected to be lower over the long run. Understanding your risk profile and your investment risk is important to help better prepare for market movements and make informed decisions. Being invested outside your risk profile is a risk itself. If you're invested too conservatively, that risk may be missing out on potential returns that you could have. If you invest too aggressively, you may see greater falls during market instability than what you're comfortable with. Both of these scenarios do not result in an optimal outcome, so it is important that you know where you sit. You can find the investment risk profiler on our website under the Resources tab. Now, what else do you consider within your superannuation? Within super, you may have death and terminal illness insurance, total and permanent disablement insurance, and income protection. These are very important insurances as they ensure that your loved ones are taken care of if you can no longer take care of them. Often this may be a tax-efficient way to take out insurance. Your employee super contributions and salary sacrifice contributions are taxed at 15%. This is lower than the marginal tax rate for most people. This can make paying for insurance through super tax effective. It is important to only insure what you need with the right level of cover, so you're not paying more premiums than necessary. As mentioned, there are 3 types of insurances you can include within your super: death and terminal illness, total and permanent disablement, also known as TPD, and income protection. Death and terminal illness provides your loved ones with a lump sum if you were to pass away. This means that they don't have to worry about money during what will already be a very tough time. Total and permanent disablement, again also known as TPD, pays you a lump sum if you suffer from an injury or illness, whereas income protection pays you an income if you're injured or otherwise unable to work. These are important insurances, but you need to make sure you have the right cover. We've covered a lot today, but one last thing we want to highlight is who your super goes to in the event of your passing. Super funds generally only pay to a dependent or your estate. Dependents are a spouse, a child or children, financial dependent, or someone you share an independent relationship with. There are a couple of beneficiary nominations on the screen, but one I want to call out is a binding nomination. A binding nomination legally binds Brighter Super to pay your death benefit to your nominated beneficiary or beneficiaries. We have recently improved our services, and you can now nominate a binding, non-lapsing nomination online. One last thing to consider: make sure you go home and check your current nomination, which can be found on on Member Online or on your annual statement. It's important to review this regularly. We understand this can be a complex issue, and we have a dedicated beneficiaries webinar which takes place regularly. Please go onto our website to find when the next one will be taking place. So, what are some actions you can do today to make sure your super is on track? It may be worth considering to consolidate your accounts, but what does this mean? It means bringing multiple accounts into one. There are a few reasons why this may be a good idea. Firstly, if you have accounts with multiple super funds, you may be paying multiple sets of fees, and so consolidating your funds may save you money. Having all of your super in one place can also reduce your paperwork and make it easier to track. There also may be reasons to retain multiple accounts, and consolidating may not be the right for you. So before consolidating, ensure you review any insurances or investment arrangements to make an informed decision. You may also lose insurance, so it is best to check first before consolidating. If in doubt, seek advice. Before we move on to the Q&A section of the webinar, let's summarize some further actions you may wish to take. Consider if you need to have duplicate accounts. You may be paying 2 sets of fees and insurances. Now, not all of us know if we have more than one account. So if you have, if you've had a lot of jobs, you could have had a lot of accounts. Also, looking to the balance, if you think there isn't as much as what you thought you should have, then you might have another account. You can also book in for a super health check with us. There is no additional cost for this, and it is open to non-members too. I'll explain shortly how to do this. Make sure you have registered for the Member Online. From here, you can manage your super online and update things like death beneficiaries, investments, update details, and consolidate accounts. Another action is to consider advice. Today, we've talked about the importance of getting advice several times. I'll go through our different range of advice offerings in the next few slides. What makes Brighter Super different to other superannuation funds? It's our commitment to personal service. We have a dedicated team of member account specialists here to support you. If you'd like to talk to one of our staff one-on-one for more general information about your superannuation, then why not book in for a super health check? These are 15-minute super health checks that cover a variety of areas such as contributions, insurance, and beneficiaries. If you'd like to book now, there's a QR code on the screen. You will also receive a link to book a super health check in the coming days alongside today's webinar recording. And once you've got the general advice or the general knowledge, the next step is to get tailored personal advice. We offer a range of personal advice options suited to individual members' needs. If you're looking for specific information about making contributions or investment strategies, our intra-fund advice team can help. Book in for an over-the-phone meeting with a financial advisor at no additional cost. We also offer a range of paid financial advice services, such as a retirement health check, scaled advice, and comprehensive advice, which you can see on your screen. The cost will depend on the complexity of the advice, and this cost may be deducted from your Brighter Super account. For more information on our range of services, please visit our advice tab on the Brighter Super website. Similar to today's Super 101 webinar, our seminar webpage includes a range of upcoming webinar topics. Keep an eye on this page as we update it regularly. On the previous two slides, we discussed our range of advice services. These cover our super health checks and intra-fund advice, both which are at no additional cost to our members, to the other types of advice such as retirement health checks, scaled and comprehensive advice. Our next poll question for you is, after today's webinar, are you planning to get advice? Yes or no? Awesome, guys. So it's great to see that some of you are considering getting the right advice to put you in the right position. It's really good to see. So again, I've covered off, a lot of ground today. So, remembering, you can also visit the resources tab for calculators and forms and info sheets for more information on what we have discussed. We've tried to answer the questions throughout the webinar today, but I will invite Silas back onto the screen just to ask any questions or answer anything that we couldn't get into the Q&A chat. And also just during the Q&A and while Silas comes back, I'm going to revert back to the Super Health Check slide just to give you all the additional time if you just wish to book in for an appointment. But over to you, Silas.
Thanks, Jack. Thanks for that presentation, and amazing. Every time seeing and listening to your presentations, I learn a thing or two. We've had a number of questions which have come through, which we have managed to answer those, and it's obviously very obvious that you've done a good job because there were not very many questions that came through apart from two questions, Jack. So thanks very much for that.
Appreciate the kind words, Silas, and thank you for answering the questions throughout the chat. Everyone, thank you so much for taking the time to come along and attend our webinar. Just one last question before we bring things to a close. Please just let us know how satisfied you were with today's webinar. Up on the screen, you can see very satisfied, satisfied, neither satisfied or dissatisfied, or very dissatisfied. Again, thank you so much for attending today's webinar. We very much hope to speak with you soon. Keep an eye out for that email for you to, rewatch the recording or book in for a super health check. Thank you, guys.
Thank you all. Thanks for coming.